right, let's widen back out. Big picture here. For that, we want to bring in Eric Shoenstein. He's the Managing Director, Chief Investment Officer, and Portfolio Manager, Jensen Investment Management. Thanks so much for joining us this afternoon. All right, so Eric, let's talk big picture here. We talked a little bit, I don't know if you were listening at all at the top of our show. We were talking about Alphabet, Google. We know there's an AI aspect to what they're doing, what they're developing now. What are you looking at in terms of where AI is and the investment and inflows that are happening there?
Sure, Diane. Thank you for certainly. First of all, thank you for having me. Yeah, AI obviously has become the dominant theme for, gosh, all of 23, most of so far this year. I think what's interesting about it, and what when we think about trends like this, it's worth noting that we look at investing as a long-term play. It's not something that you're going to try to get a little bit too frisky in terms of trying to take advantage of short-term trends. You want to understand what's going to make the business successful from a long-term perspective. How are they investing in these sorts of things? And where are they able to take advantage? And, right now, I think AI is mostly, I don't want to overstate this, but it feels very much like it's very much a hardware play more than anything else. When you think about an Nvidia, when you think about all the semiconductor companies, things like that. But I think there's some other ways to think about AI that maybe are not as well thought of or have not been as mostly thought of. For instance, one of the companies that reported yesterday, Accenture. It wasn't necessarily a great report from the way the market interpreted it, but Accenture for us is a company that they're a leading technology consulting group, and they've had a fairly decent track record of investing in new trends, new areas where they can be helpful with their clients, and AI is one of them. They've had over $1 billion in new bookings that they've created through new consulting services related to how companies are going to implement artificial intelligence into their business. And that's going to be a growing opportunity for them, but it's on top of a foundational set of strengths across the business where there's a lot of free cash flow that's being generated, which allows them to be more resilient in something that may have some cycle to it. I don't think that AI across the board is always just going to be up, up, up. It's going to be something where there will be some give and take, and we're going to have to see how that plays out. And I think having a strong cash flow generating, value creating business like Accenture that is adding AI skills as a complement is frankly kind of an interesting way to think about that theme.
What other companies are best positioned to take advantage of this, newer frontier, this Gen AI space?
Well, you certainly have a lot of companies that are already utilizing AI in their businesses. Everything from, frankly, healthcare, where they're developing pharmaceuticals based on AI, to using it to write software, to all sorts of things in between. We have some investments in AI or businesses that are utilizing AI, doing a lot within the AI space. I mentioned hardware earlier. We've got investments in KLAC. We've got investments in ASML out of the Netherlands, where these are companies that are benefiting from the massive infrastructure that's being built. But and then you have companies like a Microsoft. You mentioned Alphabet. We certainly have a play there. And frankly, even companies like Intuit, where the software they utilize for tax preparation or where people are utilizing it for small businesses. There are a lot of other opportunities within the space that I think have been a little bit ignored, frankly, in the market, where everything has been about Nvidia. And that's not a knock on Nvidia at all, but that crowded trade, frankly, I think from our perspective and a long-term perspective, could use a little bit more diversification.
All right, let's talk about kind of where we're going in the week ahead. Next week, we have a focus back on inflation with the Fed's preferred gauge. What is your take on where we are, and what are you looking out for in terms of the print?
Yeah, well, we've seen certainly that inflation obviously was a huge theme last year, but price increases, frankly, have been moderating in the last little bit here. And you're seeing that from the consumer staple side of things. For instance, you think about the Pepsi or Procter and Gamble or companies like that where their cost inflation has begun to subside somewhat, and they're not doing as much on the price increase side as much as they're now sort of looking at how do we go about increasing volumes. Last year was a much more about, or the last couple of years was capturing price to offset the inflation. Now that we've got margins sort of back into somewhere where we think they should be, you may see that that's an opportunity for them to bring some of those prices or not necessarily increase them quite so quickly. Frankly, for instance, a business that we like in our global strategy, a company called Compass Group. Compass Group is in a place where, because of their scale, they can pass price on in a pretty meaningful way. But now that the food inflation has begun to ease, really now what you keep talking about is labor inflation. And frankly, that's not necessarily something that's slowing down. We also need to be concerned about transportation costs. And so there are the inflation story, frankly, is not one that goes up and then goes down. It has some sort of stair steps to it that can make it a bit more challenging to navigate for companies that are less strong in their ability to absorb price increases after the moment where they can pass them along as price increases. And I think that's going to be one of the stories that we need to think about over the next few weeks and months is what do we do about any kind of stair stepping or pausing in sort of the inflation story, maybe even a bit of a re-increase in inflation, which kind of goes back to something that was being discussed earlier, which might be that we don't get as many decreases in interest rates from the Federal Reserve as a result.
Yeah, that would be interesting to see because, where we've started out the year in terms of expectations and how they've moderated now. Really quickly, before we lose you, Eric, I want to get into, you talked about a couple of picks that you like. Stryker, I know, is on your list. What's the thesis behind that?
Well, Stryker has been a beneficiary. Obviously, they do orthopedic implants and they do medical and surgical equipment. The medical and surgical equipment segment certainly has been a good stabilizer for them. But now with procedures back to where they should be, now you can start looking at it as a growth, a nice growth company, certainly a first mover advantage in terms of their robotic platform. The Mako system gives them a leg up, not to use an orthopedic implant synonym there, but I think it gives them an opportunity to really take advantage. Now, it has had a really nice run in the market, so I wouldn't necessarily say it's the cheapest stock on our list, but it's one that has consistently produced cash flow, recovered well since the pandemic has sort of subsided for the most part, and I think it's poised for continued good growth in the future. I would, sort of think that we need to be probably a little bit cautious about the pricing, but we're willing to be there from a long-term play.
All right, willing to be there for the long-term play. That's Eric Shoenstein, Chief Investment Officer of Jensen Investment Management. Thank you, Eric.
Thank you, Diane.